What is going on, guys? Welcome to this video. In this video, we are going to be talking about ICT concepts. This video is mainly going to be a little introduction for those who are new traders or even intermediate traders looking to get into ICT concepts. But I'm sure that if you are a seasoned trader, if you have been trading ICT concepts for a while now, I'm sure you will also find value here because this is going to be a great refresher of the foundation, which is oh so important. By the way, guys, make sure to stick around till the end, especially if you think the content of the video is interesting and valuable, because at the end of the video, I will be giving something away and I'm sure you don't want to miss out on that. So make sure to stick around till the end. So first things first, let's quickly summarize what we are going to be talking about in this video today. So first, we're going to cover what are ICT concepts. We're going to talk about liquidity, imbalance, displacement, the market structure shift, the FVG or the fair value gap, and then we're going to be covering how you can actually trade ICT concepts. So we're going to be talking about the entry here. So what are ICT concepts? ICT concepts are very big. To give you a quick summarization, it is basically the father of the smart money concepts, which is a more refined version of ICT concepts that has been pulled apart and pulled into all kinds of directions where people don't really know what they're doing anymore. But let me quickly summarize what ICT concepts bases itself on. By the way, ICT concepts is something that was created by the inner circle trader, which his real name is Michael. And it basically tells us the story about how the market works. What ICT concepts is basically teaching us is that the market is run by the smart money. Now, what is smart money? Think of the smart money as the institutions, the banks, and the big hedge funds, who are all circulating cash around through the forex market, through the futures market on the daily. And this, by the way, are trillions and trillions of dollars. So that's a lot of money. Now, what ICT concepts also teaches us is that the market on the lower time frames especially is ran by algorithms. So there is a lot of high frequency trading going on ran by algorithms. And a lot of people have actually been saying, this is bullshit, I don't believe in that, but it actually is not. If you go ahead and you look at what the top corporations are doing, for example, BlackRock, they have an AI named Aladdin. And Aladdin, if you Google it, if you're interested in that, you will see that Aladdin actually makes up around 70% of a lot of the financial markets. So there is definitely some truth there. So what does ICT concepts target? We are basically going to try and target the stop losses of the retail, of the smart money concept traders, of the dumb money, so to speak. The dumb money is basically the retail money. It is basically referred to the losing traders, which, let's face it, is around 95% of people. ICT concepts will also teach you how to avoid traps and actually join the smart money in the trades. So when we're talking about the retail traps, the smart money concept traps, all of these things, we need to talk about liquidity. Now, quickly, what is liquidity? Liquidity is basically what is needed to drive the market up or down. In order for someone to buy, someone else needs to sell, and vice versa. And where are those stop losses, these sell orders, these buy orders, these take profits, all of these types of orders, where are they usually going to be stacked? Very simple answer. They are going to be stacked old highs or above old lows, which I try to visualize right here. So what I've visualized here is, for example, two relative equal highs. Now, if we think like the retail traders, if we think like support and resistance traders, or we think like breakout traders, they would be entering shorts around right here. And because of these relative equal highs, they enter shorts right here. And what happens, and I'm sure this has happened to you, especially if you've been trading before, they get stomped out of their position before it actually seems like the market starts to reverse in their direction. Now, there's a very good reason for that. Why do we first push up there before actually going down? Well, that's very simple. The institutions, they are trading with a lot of capital, a lot of money. They cannot simply enter a position by the click of a button, so they will need liquidity. In other words, they will need buy orders for them to sell. So what will they do? They will trigger a lot of people into sells right here for them to drive price higher, because if they sell, they can buy. And then as soon as they have accumulated enough liquidity, they will use the stop losses or the entries right here from the breakout traders, which are all going to be buys. So if you sell, your stop loss is basically a buy. And if you buy, you just buy. And the institutions are going to be selling to those buyers, right? So they are going to grab a lot of people's money to then start moving the market to the downside. To fuel that move, there is liquidity needed. And this is visualized right here. And these are two patterns that if you open the chart right now, you will see them everywhere. Another great example is this is a higher time frame picture where you will see that the market seems to really explosively move to an old high and then all of a sudden reverse very aggressively. The reason for that is as well because above that high there is going to be liquidity, so there are going to be orders that the institutions can then use to fuel the move to the other side and make money on their positions. Now we are going to talk about imbalance. What is imbalance in the market? To quickly and simply explain it, imbalance is when the market moves super quickly and the people that try to get in orders basically don't have a chance to get into them. As you can see, this movement happened in 1 minute. Everyone who was trying to sell right here probably didn't manage to get in. So there's going to be a pool of orders here. That's basically imbalance. And how do we define imbalance with ICT Concepts? It's really simple. It is once we have a candle where there is no wick or body from another candle directly next to it to the left or to the right. That is imbalance. Quickly look at this first image. Where my cursor is right now, this right here would also be imbalance. And the story right here is that imbalance usually gets filled before we continue making bigger moves. So this right here is the same imbalance point. We can see that price fills up this imbalance, so picks up those remaining orders before then, and again, this third one is also the same, before then displacing lower. Study this on the chart as well. I'm sure you will see this. And in the next few slides, I will actually teach you how to capitalize on this. Now we need to cover two really important topics as well. That's going to be displacement and the market structure shift. We have to know that when the market moves and it moves by institutional money, we will usually see very big candles, like visualized on the left right here. Here we sweep liquidity and then we push lower quite aggressively. This right here is not done by retail orders. This right here is a lot of shorts coming in from the institutional side. As soon as we see that, the market basically shows us its hand and we almost predict where it is going to go if we use ICT concepts properly. How do we define displacement? We want to see a break to a previous level. So in this case, that's that line right here. We break through this previous level. We break through it with speed and with momentum. So as we can see, there is a lot of speed here. There's also a lot of volume behind it. And as you can see, we convincingly close below it, indicating that the market likely wants to continue short. If we compare the amount of buyers here to the amount of sellers, it's very clear to see that there is displacement to the downside here. And how do we call that move where we actually break the previous point of structure? That is the market structure shift. This is an indication that the market might actually be shifting from being bullish in this case to being bearish. This is your first signal right here. And that is what we call the market structure shift. As you can see, this right here is this line. And that's where our market structure shift occurs. So now we have to talk about the fair value gap. I'm sure you've heard about this and a lot of people make it really complex, but it's really simple. All we need for a fair value gap are the following factors. First and foremost, we need imbalance. And if you know anything about ICT concepts, if you've been watching other content creators, they have been saying that every single bit of imbalance is a fair value gap, but this is not the case. A fair value gap is imbalance located in a premium or a discounted zone for you to buy or sell. So not every single imbalance is a safe place to buy or sell. So we need to set some specific rules to make it a fair value gap. First and foremost, we have our imbalance. What do we also need? We need to see that we have a protected high. In this case, we can assume that this is a protected high because we can see a lot of orders got liquidated here. We see really strong momentum to the sell side from the institutions. Then what do we also see? We can see the market structure shift. And then if we move to the right here, we can see that if we take this leg that displays to the downside, we can see if we pull a fib tool, and I hope you can see it. I will enlarge this image for you in just a second. We make this move all the way down, this imbalance, which is fair value because it is above 50%. And then we start shooting back down. And everything above this 50% is going to be our premium. So we want to be selling in a premium and we want to be buying in a discount. So here is that picture enlarged for you guys. As you can see, we have the sweep of liquidity. We have the push lower causing the market structure shift for us to then pull all the way back above equilibrium or above our 50% level. where we have our imbalance, which we can classify as our fair value gap. And I'm pretty sure that a lot of people will be thinking now, hey man, I can also just cherry pick things on the chart. And of course, that is the truth. But what if I told you that this is price action from today? This is actually something I traded today. So this is happening in the market almost every single day on almost every single pair. And I really encourage you to look at the chart and find this. Now we're going to talk about what is really important here. We are going to be talking about the entry. And now you are going to see what the puzzle pieces are that we need for the entry to be valid. First and foremost, we are going to need the sweep of liquidity. We are going to need the displacement to the downside. We are going to need the market structure shift. And then we are going to need our fair value gap. And that fair value gap right here is going to be our entry point. And then for the sakes of keeping it simple, and again, I do refine this for the people in my community, our stop loss can go above the previous swing high. And as you can see, this right here is a swing high. This is where our stop loss goes. And our take profit can actually be your closest draw on liquidity or a bit beyond that. And the draw on liquidity is basically going to be your next point where the major liquidity is going to be residing. Meaning that below this low, if you remember the first slide that I covered from liquidity, this is going to be a significant low. There are going to be a lot of orders below that, which the market is going to need to continue moving up. Now, of course, I do understand that this video was really quick, really packed with a lot of information, and I know that you might actually need some more. And when it comes to ICT Concepts, this video alone won't make you a profitable ICT Concepts trader. When it comes to finding and personalizing, these are going to be your main things that you need to do with ICT Concepts, because I'm a strong believer that not every single strategy is suited for every single individual. The beautiful thing with ICT Concepts is just that. It are concepts. We can apply them in any way we like. And this is something that you're going to be seeing in the online spaces most of the time. All of these successful traders have used ICT Concepts as their foundation. They don't trade a strategy from someone else because someone else's strategy might just not be suited for you. And that is something that I personally teach my students in my elite program. I teach them to refine their ICT concepts, refine their entries. I teach them how to build their own models, their own strategies, how to find consistency, how to personalize everything, how to have a complete plan every day you attack the market. I teach them accountability, risk management. They have support from a massive, massive community full of like-minded individuals. And then, of course, we are also talking about psychology a lot. If that is something that you are interested in, because we are approaching the end of the video, I do encourage you to check out my elite program. You can also join my Discord server for completely free and then make your decision still, or just look around at my YouTube channel. But if you found all of this interesting, and if you go to the charts and there is a click, make sure to check out the link in the description where you can actually sign up or apply to becoming an elite member. And also know that the elite membership is actually a very exclusive, because it has been application based for all this time, but right now I decided to actually open it up for the public for a limited amount of time. So if you're watching this video, quickly check if the elite program is still available to the public, because it will be closing again soon. Because as soon as I reach an amount of members that I'm mentoring, I want to really reserve my time and slots for those people. I close off the community and I only open it back up once those people have left being consistent and spots open up again. Other than that, thank you so much for watching. I do appreciate you taking the time for this video, and I hope to see you in the next one. Bye bye.